started. Let's just put that away. Okay, here we go. Okay, this is a spreadsheet I use for recording my stocks. See here, that's the date I put in the bid and the date it got bought, and it's sell date, and well, I put an order in to sell, and then the date it actually sells. Just put down here hold sold. These are ones I've already sold. The blue ones are 2021, and the pink ones there are this month, January 22. They're sold, and these ones underneath are my recent ones. There's one there. There's a couple there bought in December. Grange Resources and Nickel Mines. And Fortescue I bought this month. Neo Metals and National Tyre. National Tyre I bought yesterday. Well, today actually. Put the order in on was it Thursday or Friday, and today it just bought it. Bought these shares. So if I take this National Tyres, I'll move this cursor along. The ticker, or the AXX code, is in this line, this column here. NTD is the ticker for National Tyre, and that's what we use on the ASX to identify that company. The price I bid in was $1.53. I got 3,000 shares. The cost of the 3,000 shares is 153 times 3,000. 4,900 and 4,590, and there's a fee. I kept it under 5,000 because the fee goes to $20 if it's over 5,000. So 4,600 was the final fee. And you can see here I've just invested 17 grand in this lot. That should be the sum of those ones there. 17 grand in that. And what's this one here? Yeah, we'll ignore that. There's got some hidden cells in there. Okay, so and that's the net cost in the green column. The quantity, because I'm gonna eventually sell. I might not sell the full 3,000 because I've got 5,000 in there. I might go up to a fixed value or percentage, and then sell maybe half. And that's just to get some money back, so I'm guaranteed that. So it might be $100 or so. I think on Grange here, you can see this one here, Grange Resources there. I've got 750. Actual fact, I bought 1,500 because I sold Grange. I sold half my stock here, and I got back $41. Well, that just covers my costs, but it was just this is just a new system I'm working at the moment, so I wasn't really worried about what I made out of it. It was actually 8% of the actual $510 that I'd invested. Don't forget I split that, and at the moment you can see Grange is trading at 84.5 cents, and $101 at 20% ahead at the moment on that. Recently I bought Neo Metals, NMT is a ticker, and you'll see that it's a loss at the moment. It's because with share market it goes up and down like a yo-yo. You can't pick the exact spot, but you get close to it, and if it goes down a bit, it might come up a bit and go down a bit further and go back up. So it's all very good as long as I got myself set up properly. So you've got this spreadsheet. I send it to you, and you can use this spreadsheet. So all these ones here, they're all sold. so maybe profit and loss on those. So I'm not doing too bad just lately, but these are all small amounts. Just my tests at the moment, make sure it's working properly, and we're looking pretty good. I think I got one near that near metals. I know there was one here. I said, yeah, Memphis. I sold that. I had a stop loss on that. It's just a stop loss is a figure I put in my head, and I actually record it on this spreadsheet, but I've hidden the columns. And if the price goes down to that point, I sell. Okay, must sell, because if it goes below it, then I'm losing more money. So I say at this point here, I'm not going to trade anymore. I want to sell it. In actual fact, with this MEM, what I did, I seen it the past couple of days, and instead of it going up as I thought it would do, it went up and started coming down and started losing money. And when I reevaluated it, I decided, nah, I'm going to sell it before I reach my stop loss and just keep my losses down. You see, so I lost $120. You know, 12%. Well, I set my stop loss as about 15%, but that's that. Alright, so now I want to show you, this is trading view, right, and this is Grange. I've just brought this up. So I always set these up on 3 tabs because I'm not I haven't got an account with trading view, so I can use their facilities for free, all their indicators and everything. I've set it up different to what they do, so it looks a bit messy for you, but let's go through what I'm doing here. On my first tab, I need to know, first thing I need to know, what's the trend? The stock's going to go up or the stock's going to go down, right? So what I do is I stick in a 50 SMA and a simple moving average. MA is moving average, usually means simple because it's just an average of all the prices up until that point, and I've made the length of that 50, so it's 50 in this case using days, which is up the top left there by the ticker. So 50 days, 50 bars I should say, which is 50 days, and that's days when the stock market's open. It doesn't include Saturday and Sunday. So, and I set it to a style of blue and a thick line, so just so it stands out a bit more. Now that with that 50 days, it's sort of long term, or at least long as far as I'm concerned, because I'm swing trading. I buy now and maybe 2 or 3 weeks I sell. So you can see here to the left there, the stocks, it's increasing, goes up, and you can see the 50 SMA is coming up, and it's lagging. You see how it lags? It's coming down when you're halfway down a downtrend. It's lagging like that because it confirms that it is in a downtrend, because the price can come down and just go back up again. Look. So it comes over when it's flat like this. I don't like to trade when it's flat in that area. If it's just going up and down, if it's shallow, up and down, not a good idea, because it's it's fairly flat and there's no real volatility. No one's committing to buying anything or selling anything. So Grange, why did I buy it? Now let me have a look on my thing here. Now Grange I bought on the 16th of the 12th for 68 cents. So go back to what I say. The 16th. So where am I? I'm on the 7th there. So 16th is that day. That's that candle there. I usually make that a purple. Just lets me know that's when I started trading. And on that day, I actually bought it at a high price. You need to look at the candle. Oh, sorry. Yeah, I bought it at a high price. If you know how the candles work, let me just get in here, see where I bought this. Opening price, because it's red, it came down during the day. The price went down during the day. So I bought it there, and the price went down, actually went down. Now I was looking at yesterday's price and thinking, yeah, I think this is going to be a good one to buy. It's going to go ahead. And it actually fell during that day, but it came back up the next day. So if you know about the wicks, if it's green, it means the open price. You can see up here, there's the open price, the high, the low, and the close, and it'll give you the difference, how much difference, and the percentage difference. So on this day here, it went up by 20%. There's a gap there, which means it was from there to there. Should have been about 20%. And just using that, you'll find these over on this side, down there, price range. But I just set up that there. So it's a quick way of looking at what you think the difference is in price. But anyway, getting back to where I was, I bought on this day because it's set up right for me. And I was talking about the candles one time. So the candles, opening was down here. This day it opened at 68 cents. It's low. During the day it went down. So it went down to 67 cents, so it lost a cent. It went as high as 76 and closed at 74.5 cents on that day. Now if it's a red candle, it's doing it the other way around. So if I pick this, let's pick one that's got a wick on it. 2 wicks there, one there. You see this one here? Okay, so it opened and fell during the day, but it had a high of the day. So that during the day, that opened at 65, went up to 66, came right down to the low of 62, and closed at the end of the day at 63, at minus almost 6%. It came down during the day because it's during the day it came down 6% from the end of yesterday's close, because yesterday's close is at this point and it comes down there. So it went down there to there, which is there, your 6%. Okay, so you can go at this tradingview.com. You can use it yourself to set it up. So I'm going to tell you how I set these up. First of all, I got that mean average there of 50 units. So let's bars, 50 bars. Let's call it bars. It's not days because it's closed on Saturday and Sunday. So if I get the date range here, so I say for this red one here, back to that big one there, you can see it's 10 bars, but it's actually 14 days, 2 weeks. So they work 5 days a week, you see. I mean, the stock market's open 5 days a week. Okay. You can see it's rather flat just here. The SMA 50 or moving average of 50. It's rather flat there, and in this area here, you see here, this is this grey bit. It's called a Bollinger Band, and it's squeezed up in here, which means it's in a kind of a holding pattern. a holding pattern. It's not going very far, and the tighter it is, the less it's going to go. So prices only moves within a 13% range. It sounds great, and if you're lucky to pick the bottom and sell at the top, good on you. But I know, it's bloody difficult. So when you're in this, you don't really know where the bottom is. You're just going to buy it at some point and then sell it at another point. So it's all about getting the most out of it that you can, knowing that it's all risk, and you try and minimize the risk. Now, to get the 58, these indicators up, you go to the indicators up here, and you can go to the built-in. I just, if you come to these indicators on there, the star there, it says add to favorites. So if you click on that, it puts them in your favorites. So I get all mine all lined up, so I can go straight to my favorites each time. But you'll start off and you'll come in here at the built-ins and look down the built-ins, and you look for a moving average, just a moving average. Several different kinds. There's a moving average, there's a moving average convergence, divergence, and a moving average exponential. Well, just take it as we're only going to use the moving average and the moving average exponential. The exponential is just a different formula, rather than it being multiplied over that. Look at a range of those same. It'll look at the range of the same period, but this one here, because of the way they've done the formula, it makes things a bit quicker. So because moving average is quite slow, using an exponential, the maths in it makes it makes it move a bit faster when they put the lines on the chart. Okay, so on this one here, I have the 50 MA. So when I go over here, put the 50, it's called the simple moving average, but they abbreviate it as MA. And you've got a little cog there, that's your settings. You set your settings in there. Got the color, which I showed you before, and over here you got the length to 50. There's no offset, everything. So the only thing you're looking at is the style and the inputs. And you can do the same with the Bollinger Band. You go in your indicators, go down looking for Bollinger Bands. So this is how you set up your first tab, Bollinger Bands. And watch this, there's several. There's percentage speed, there's Bollinger Bands. Bollinger Band, just ordinary Bollinger Bands. It's the ones you want. And that's set at the normal 20. Inputs is just a 20. The length of that is a 20 candles on 20 working days that the ASX is open. It looks back 20 days, and it gets a standard deviation of 2. It's a standard deviation there, which is what it usually set up to. So if it looks back this period here, it looks back 20 candles. It said during that period it was very narrow, and so this gets narrow. And Bollinger Band represents volatility. Volatility is if it goes up and down big, a long way, the big variances in the prices, high and low, then you get a widening of the bands. If it's narrowed up like this, it's in this what we call range, and it's very narrow like that, and it's not moving much. So it's about 5% there. So Bollinger Bands, you leave it at 20 and leave it at standard deviation 2, which is the default. I just you don't necessarily need the basis. The basis is a standard deviation of that 20 moving average period. I just changed the colour of the top and lower bar and the background so I can see it better. You know how blind I am. Just ignore my horizontal lens here. That's just where I'm holding at the moment, and that's my target. So okay, why did I pick that date? Okay, so now, first things first, it's going up, so I know it's an uptrend. See how both the top and bottom, if you go over this side to the right, you can grab that there and pull it down, and it winds and shortens everything so you can get on your screen better. So you see how the top Bollinger Band expands out and the bottom one expands out. It means it's in a very good uptrend, which means there's a lot of people bidding, trying to get in. You see how it's gone up and it's gone over that, which is a good indicator that there's a lot of people interested in it. And if you put your cursor over it, you can see over here it's got the volumes as well, and it's actually volume just down at the bottom. You see the little towers, high volume, that one on that day. It's because it went a long way. People seen it gapped. As soon as they see it gapped, they jump on board and start buying. It shoots up. Problem with the gaps like that, usually it reverses straight afterwards. Next day it's coming down, which it didn't in this case. It just went sideways, and then it eventually did fall, but it came virtually to the midway. And I think if I put on here a what is it, a 15? Yeah, I think it's a 15. Good, my favorites. If I put in a moving average exponential or EMA, but put one of those in. Now if I put it, make it let's make it black, shall we? And put a bit thicker line, and I make the infinite. The default is 9. If I make that 15, I'm pretty sure it's 15 now. 14 or 15. I'll leave 15. I think it is. See how it's come down, and the price at that point there, it came down and sat on the 15 EMA. It came down, sat on that, which means it's creating a bit of support for the price. Because what everybody trades the same, you know, in a big way. Lots of people, a lot of them trading the same, and their price comes down, and they say, "Oh, we're below that there. Oh, it should really be above that." And people price around this area here, just above the EMA, or any support actually, like this 50 EMA moving average. It comes down here and it's bounced off the moving average, and it sort of held it through here as well a bit. It came down, hit the bottom Bollinger Band, and came back up and sat on the 50 EMA, gone up. A lot of people got interested. It started buying, went well over the top Bollinger Band. It's come back, and it's gone up again, hit the Bollinger Band, gone sideways, dropped down to the support at the 15 EMA, and off he goes. It's just above the 50 EMA, and here we are today. The price has been over. Yesterday it went over the top Bollinger Band, but it's closed under. And again here, a bit of indecision today because it's not moved much. It's like an X, which means the movement up and down hasn't gone very far, which is a bit of indecision by people buying today. It's Mondayitis. Sometimes it goes crazy, and sometimes it doesn't do much. You can also look down at the volumes as well, very low volumes. You see that? It's just moved. See that? Somebody else has just bought something. The volume and everything just moved. So the black line, of course, is the average, moving average. I think that's over a 20-year period. If I look over here, and the volume, going to settings, so the moving average length is 20. Style, I changed this to I like to keep this aligned, so it's there. Use different types of things. It's a line, you can have it as, you know, a filled area if you want, but I like to see the lines. Okay, so that's my first one, and I just pointed out to you, when you got a lot of variations in the price and a lot of volatility, you get these Bollinger Bands get wider. The 50 moving average is a good representation of which way the price is going to move. But it isn't exactly accurate. It's a lagging behind. So as I said down here, the price here is coming down, and the moving average doesn't start coming down until it's almost near the bottom, because it's a lagging indicator. But for purposes of trading, when you want to buy, if you've got that coming up, you know that you've been in an upward trend for a while. Another thing you've got to take into consideration when you're buying at this point here, right, is how long you've been in the markets and this uptrend as such. So what we got, so I'm going to use some lines. We're going to draw in lines. This is what we've got here. No, I can't do anything there. What's it? Give me 5. It's 5. Edit waves. So we'll talk about waves now. The 50 moving averages is here. Starts to move up there. Let's count how many waves there are. Okay, that's the first wave there, and it goes to the high point, which is there, and this low point here has got to be below that price there. In actual fact, it probably isn't, so you missed that. So at high one there, as it comes down, you can't call it the end of the wave. The wave is still growing, still growing, still growing, still growing. That one there would be, because the one below it is well clear at the bottom of that price. So there's wave 1, comes down. That point there is the lowest in this lot, so that's wave 2, and that one isn't higher than anything else. This one's higher, that's the highest at the moment. So we're still on wave 3. Now the average is 5. There's 4, there's 5. So we're still on wave 3, and on average wave 3 is the wave that lasts longer and you get the most profit out of. So if you can get in where I have, which is right at the start of wave 3, you should expect all the profit going up on wave 4 and with wave 5. And wave 4 come down. So the other thing about this is, see that how long that is? It's a long period. It's got all these days, and it's only risen up a bit. So that's called an impulse move. And this one here up there is an impulse move. Well, actually, in fact, this is the impulse move. 1, 2, 3 candles down here. The 3 candles, the impulse move up. Then there was a bit of a deflection coming down here, and it's a bit longer coming down, which indicates that it's more of a downtrend than an uptrend. But you're actually in the uptrend, because you're looking back on the 50 EMAs telling you it's going up, and of course it reaches a 50 moving average and it's gone off again. So we have the overall effect of that lot there is it kept on going up for the first wave finished, and then it's come down and it's not got any further. It's hit the EMA, was it 14 or 15? I don't know. 15 EMA. It's hit that and decided to go on the next wave. So it's gone again. So get a big long rush for one wave, an impulse move that way, down, it's a retrace. There usually is a couple of days between, but it isn't here. But it still is a downward move in price. That's your lowest point, and it goes on for your next wave. So you've done 3 waves so far, and there's wave 4 and wave 5 to go. So where I bought in, first of all, wasn't there. So this is just one more thing, just to confirm that I'm buying in the right location at the right price to make as much profit as I can. Anything else on here I need to say? Can't think of anything on this one. I've just set up some targets, that's all. That target there was my first target, which I sold at. I think I showed you that bit. Go back to this. Great. I sold at 76.5 cents just to get that profit locked in, so I got my money back, so to speak. If I had it, I think I didn't use Billy. How much did I use? $700,000 was it? So it's 500 there. It's 500 there. So yeah, about $1,000. So there's not much money in it. So as I say, I'm just trying this at the moment, this new system. Okay, your next sheet. So you just, let's come back to the first. I just right click on the sheet and go duplicate. It makes another one. And I get rid of the indicators on this second sheet because you duplicated it. And I'll put in some new indicators. There's none there at the moment. Let me get rid of the waves. I'll get rid of those. Right now, you notice how it puts any lines and everything on there. It just copies that one over, whatever's on there. So I've got my horizontal lines and my vertical line. Okay, so on this one, I look at looking for the actual best place to start, and to use that, what I use is the stochastic. That's the stochastic. So I put two stochastics in. One, click on it once, there it goes. Click on it again, there it goes again. And the other thing I do is also use the commodity channel index. Now the commodity channel index on the bottom, I don't usually change that much because that's okay. But these two stochastics I need, because I put the two of the same thing in, they're actually set up. The defaults are all the same. It's 14, 1 and 3 length, smoothing and smoothing for D. Now I want to make the period that it's looking back on this one different to that the next stochastic, so I'm getting a difference in assessment of what's going to happen in the future, because there are two different time periods. I'm going to get two different results. But if I get a time period where both the results say exactly the same thing, that's confirmation that whatever it's saying is correct at that point in time. Okay, so this one here, the top one, I usually set this up at 3, 14 and 7. So I put in 3, I go 14, and the bottom one, the smoothing 7. So stochastic, and I set up K. I always use as black at K percentage K. It's black, but in this particular indicator, I don't need D. And D, I'll just go okay on this. See how D, it's longer, and percentage K, it bounces a lot. Well, I want that percentage K that bounces a lot. I don't want the D, so I just get rid of the D. I can leave this as. I can change my background color, and I might thicken up the line so it can stand out a bit more. So that's first stochastic setup. Okay, and it just goes down, up. Now what people usually use the stochastics for is to see whether a particular stock is overbought, which would be at the bottom, or oversold at the top. Way we look at this stochastic, we don't call it overbought or oversold. The only reason why I want this stochastic there is I ain't bothered where it is, Usually like it, you know, below 45, but I want to see these hooks. See how it's V'd down like that? So now what I do, I'll go in this other stochastics and I make my settings are different. The colouring is virtually the same. I set this to 55, 45. Let's get my background colour there. Now my inputs. This one, the K length, I'm only looking at 2. That's 2 bars, okay? But my K smoothing, I want it as 5, so it smooths it better. And I leave the 3 there. Okay. Okay, now look at this. The yellow one, which is percentage D, is still, it's just a bit lagging. Actually, it looks like, you say it's lagging. You'd say, oh, but it's in front. No, no. If I look at this point here, percentage K, which is the black line, it hooks back up before percentage D, which is the yellow line. Percentage D is still coming down, but percentage K is hooked over. These hook over, if you can get them to line up like here, the stochastics, and this is hooked over, that indicates a price rise. It's at the bottom, it's before 45, which is great, and this one, not too fussy, it's a bit high, but it means just a bit later in the price. But there you go. So that point there, if I put a thing in here, best point for me to enter would have been there. It doesn't always work out like that, but I might make that a bit narrower. Oops, probably too much. So that's where would have been a good place to start, because when I did my screen of the stocks, I didn't notice this until the 16th of December. As when I found it and thought, oh, the price dropped down. Just there, the prices dropped down. It's a good time to get in. So I just waited it to come down. It hooked over again. Didn't hook over on the top stochastics, but I know, a good feeling that I should have bought it there, but I was too late. But it went up, it sort of dropped off. The price has dropped off here, it dropped off there, and it hooked over. So percentage D, and this is what the hell they call this? Oh, it's virtually the trigger to the buy indicator. Now, if I look below where I should have bought the CCI, I haven't changed that, commodity channel index, is going up. It's above 0. It's going up, 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 and because of this drop down, it came down. But I still bought there because it looked like, this looks like momentum's going right, even though on that day I couldn't see what was happening back here. Everything here was set up. Everything here was set up. Confirmed it. This confirmed it. So I'm very happy to put in a bid here. The only thing I didn't like was this thing here, which is when they pay the dividend, because sometimes that affects the price, and it probably did. On that day the price dropped, people got pissed off, the price dropped, which was a win for me, because I should have been in here, and there's just a price difference there to there, 10%. You see, I've lost out on 10%, but I'm in there anyway. I bought that, and it snuck up, snuck up, snuck up, snuck up, snuck up. So he's still on wave 3, going up. That's how it is at the moment. And I sold off at target 1, which was on the 4th of Jan, more or less. And then today it's up at 83 cents. So that is the third tab. Oh, sorry, the second tab. So the Bollinger Band, moving average, this one here, oh, and the waves as well, wave count. This one here is to get the stochastics to tell me when's the best time to get in. Because if you see, if I go back, see just here, doesn't look like a good time to get in, then it's there. Just there was a hook on this one here and that one there, which isn't a very good example. This one here is at the bottom, hook there, it went up. Where were we? There to there. So it went up 24% in looks like about 2 weeks. Well, 24% in 2 weeks is pretty good going if you got in and out. Okay, so now we'll go to the third tab. So again, you just go duplicate and it puts another tab over here, and this is the tab, and this is cleared, so there's nothing on it. On this one, what do I use this time? Okay, here we go. So I've used stochastics. On this one here, I used 2 exponential moving averages and a moving average convergence divergence, which is your MACD, they call it. So I've used that one as well. And I tell you why. People usually leave the MACD, which is this one at the bottom, usually leave it as it is. Now, on the course that I took, we'll use these settings. So it's usually 12, 26 and 9. The fast length. So the fast length is a moving average over that 12 period. The slow length is, let me think about this, it is the, what is it? Is it the exponential of those 12 periods over that 26, something like that? Then you got a smoothing signal. But anyway, we don't use these figures. I don't use 12, we use 5, we use 20, and we use 30. And the colours I change for these colours. Signal line, I like to have a black, and I like to have it a thin line. So you have a thicker line, even though the colour thing there. So there we go, 5, 20 and 30. Okay. The other thing I should do is get rid of the mess. Get rid of the histogram. That just makes it easier to see, so you can see it. Now the reason why I use the MACD, and it's called a convergent divergence, is going to say, okay, this is, what's the momentum of the market? So it is 0. So definitely there's 0. At the moment back here it's round about the 0, but it starts to creep up, and now it's above. So about here it's above. Now what we're looking for is an area where the price is going in a different direction to the MACD line. Okay, so you can look at this one here, that point there, see that point there at the top, go up to here, gives the top of the price, and it goes up and it's higher, so that's going up. So where was I? There. So that one's going up, and to there, that one's also going up, so they're both going up. So that, oops, okay, so that's going up, and the other one's going up, and this is going up from there to there. They're both going up in the same direction. What we want to do is to go and want them to go in the opposite directions. So what you want is something down here. Say, let's have a look at this. There's a price there. Where's it going? That's there, so it's going up. This is going up, and the price is also going up as well. It starts there and goes up, so it's not divergent or convergent. What happens here? There's the high there. There's the high there. And in actual fact, this also goes up. So we're not got any divergence or convergence. Usually if you see a bit of divergence is where these come out. No. Let's have a look. There's some there. So if that one there, if that's going like that, that's divergent. If the price is going out as well. So that day there, I'm on the top, so take the top, and unfortunately there it's going down as well. So they both go in the same direction. What you want is the price going one way and the MACD line going the other. So where am I? Went from there to there. So that's on the underside, so you take the low side. So that's going there. This one's going that way as well. So they're both going the same way. So we haven't got any divergence or convergence. I can't see anything there. Even on this really small one here, which is usually the giveaway ones, is the smaller ones. If I take that and try and tie it in, so that's there, and 2 bars up, they're up. So they're still going the same way. But what you have we got anything here? There to there on the top side? No, nothing. What about from here? From there to there. So on the underside, so look. That one's there. That one there. Now, the idea is getting this. What's that? So they're both going the same direction. So there's no divergence or conversion. Divergence or convergence on the MACD would indicate there's a shift in momentum. And so if it's going, if the momentum coming down here, it's coming down. On here, this side, the trend is to come down. If there's a shift, which I can see in here, if I show you this one, if I go down here, move this across there, what have we got here? There to there's going up. There's going up. There to there. That little one on the underside, and that one there and there. That's going up. Which is just there. That one there. And this one here. Now you can see as that one's going down and that one's coming in. It's that convergence. It's converting to each other. That can be divergent or conversion. Divergent is just the opposite way, where the price goes up and then the MACD goes down. So here is an indicator showing, hey, there's a change, there's a shift in momentum here, and look what happens. Well, it shifts, all right. It comes down and goes straight up and starts going to an uptrend. So you get these little indications on the MACD just saying, hey, we've got a shift here, and it's just something else to note that's pointing you in the right direction, saying, well, hang on, it's going to shift. So you know the trend is going to change. Doesn't always work out, but majority of the time it does, because there's a shift in the share buyers actions. Okay, that's the MACD, and that's the one of the main reasons by that. The MACD's got to be going in the right direction, and we're looking for divergence and convergence in there. Now the other two, the EMAs. Now the beauty of moving averages is if you can get crosses where the one average crosses another, it gives you an indication that hello, there's another shift in everybody's attitude. So I just set these up, and I got this for actually doing crypto. Actually, this actually set up, and I set this one up, first EMA at 20. So it's a 20 period, looks back exponential. So I use it to leave it as a black, and the other one I do as a 55 period, which is very similar to the 50 moving average, but this is exponential, and I'm using it with the 20 EMA as well. Now you can see what happens here. It's like the 50 EMA. It's a trailing. It's well behind with the actions of what's actually happened. So you got your cross in here, so you can see this cross on that day there. And I'm change it to, let's give it red, make it bigger. So that one there, and that day there, says hello, the trend's changing now, down. In actual fact, it didn't last very long after that, right? But what is beneficial with this is if you use a different time period. So I'll just get rid of that. Now if I go on a weekly, changes that there, you got name, go on a weekly, and if you had have seen it here and change that to a weekly, and I got the EMA cross, and if you had have bought when the EMA cross was roughly here, it's where it crossed. Did you got anything divergence here? Is that anything? Price is coming down, underside down, down. Doesn't really show you, does it? Up, down. No, it doesn't show anything, does it? There's no divergence there or convergence on the MACD. But what we have got is the EMA, the two EMAs crossing. Now, what's his name? Coins Kid on YouTube, he calls this a buy and go to the beach, because when they, on the weekly, when they cross, it means it's going to be a long haul uptrend. So here, if you had bought when they cross there, where are we? Here, aren't we? Well, so far they've had 580 days of uptrend. So you could have bought down there and just left your money in there in the shares and just kept on watching it grow. And from that point there, what's the interest you would have got out of it? On that point there, we can see that 211% it's grown in those 580 days. So when that goes, you know, in between it's going to go up and down and all over the place, and what you do is just put your money in there, spend $500 where it crosses there. And don't forget, you guys still got to get confirmation. You can't say that is exactly the same thing, because it could do like it's doing down here, which is goes over, comes back down, goes over, comes back down, and it's actually running sideways. So in that area there, it's all consolidating, it's not moving any. So if you had a bought just there, you would have gone nowhere, because it's, you know, in fact you might have been sold here and lost. But you have this confirmation here, the EMA cross, right? And then you around that you look at all these other You look your Bollinger Bands, your 50-day moving average. You look at your stochastics and see how they set up. Are they hooked over? Is the CI in the right direction? Going up? Is it low? So that's what I use that for. If I see that there on a weekly, and I think it'd be a great time to buy, but I always have to check everything else just to make sure I buy at the right place. So that was why I use that. So there you go. There's my 3 sheets, and I just told you how to set it all up. Now you can use, what I suggest to you is you set these up like I've showed you, and then go back a few years, pick any ticker, go back a few years and set it up like this, and get the 3 of them starting at the same date, which is the 9th of July, whatever year that is, 2020. And then you look at that and say, oh, would I buy there? Yes, I would, but it looks narrow. But then you've got the price walking up the top Bollinger Band, which is good. 50 MA is moving up. So then you look at your stochastics. When's the best time to buy? On that same day. Is it hooking over? You wait till both the top one and the bottom one hooks over, and then you look, the CCI is going to hook over as well. It's another great indication. It's a good time to buy. And of course you got the crossover. We get a crossover of the EMAs. It's another thing. And any divergence or convergence you got in here with the MACD. So there's, what is that, 5 or 6 different things to look at, and when they all align up, you're onto a winner, usually. Okay, so that's just me for now. I'm gonna